On March 19th, 14 oil and gas CEOs released an open letter to the Canadian political leaders. And what they wanted was there were a bunch of recommendations that they thought would allow their industry to realize its full economic potential. And one of the recommendations concerned the federal industrial emitters carbon tax. This is what they wrote. Quote, the federal carbon levy on large emitters is not globally cost competitive and should be repealed to allow provincial governments to set more suitable carbon regulations. End quote. Now, part of the problem with this is that most of these oil and gas CEOs, their operations would be subject to the Alberta industrial emitters carbon tax, and it's called TIER, T-I-E-R, the Technology Innovation and Emissions Reduction Technology. And it's set at currently at $95 a ton for CO2 emissions and rising to $170 a ton by 2030. Those are actually the federal levels, and the federal government enters into what's called an equivalency agreement with the Alberta government, has had one for a number of years now, where Alberta says, yes, we will abide by, at the very least, the minimum requirements, the minimum regulations as set out under in the federal regulations. So here's the problem. The oil and gas CEOs are arguing that this system is simply too expensive compared to their competitors and remember, it's heavy, ultra heavy sour crude are the grades that they're competing against. Not competing against, like shale, Permian Basin shale, light sweet crude. This is the heavy crudes. And they say that nobody else is doing this. It's too costly. We shouldn't do it. That's not the case. And I'm going to interview Dave Sawyer, who is an energy economist who specializes in this. He knows the tier system, he knows industrial emitter carbon taxing systems across Canada really, really well. And what you're going to discover is that the CEOs are being, at best, disingenuous. They are not really telling the truth about how much they pay. And I'll put it to you this way. I mentioned this in my interview with Dave. But Suncor, for example, paid 47 cents a barrel. That's it. And that might even, according to Dave, might be too much. There were subsidies and other offsets that might have lowered that price below 47 cents. That's one of the reasons why oil and gas emissions have been rising. But here's my interview with Dave. He'll explain it in more detail. So, Dave, can you give us a very brief overview of how TIER works?
Yeah, so Markham, I mean, it's a carbon pricing system, but it's neither a carbon tax nor a cap and trade system. It's a hybrid of the two. And this was done years ago to protect competitiveness, because the challenge is when you cap emissions, you don't know what the cost is, and costs can go through the roof. So they designed a system that has compliance flexibility to contain costs. So there's a buyout price, right? You hit that maximum limit, you can buy out for compliance, so you know your upside costs. And then there's an intensity standard, which is your standard that you have to hit. And if you can beat it, they give you credits, which you can sell or bank. And if you don't hit it, you owe credits. You can buy credits, or you can access your bank, or you can do your payout. You can buy offsets. So there's a bunch of trading that goes on. So when you boil this all down, these are large trading markets, big, large trading markets worth a couple $1 billion right now, growing in time to 6 or 8 billion nationally. So they're not small.
So, are we talking about an Alberta-based carbon market that is $2 billion?
Yeah, it's roughly around there. So actually, Alberta might, well, right now I gotta think about the number a little bit, but it's close to 2 billion right now. It's 20 megatons of compliance, right? And which is a fairly large number, but it's actually not that big a number given the size of the emissions. But yes, Alberta based. Alberta set this system up in 2007. It was adopted by most provinces, and then the federal government wrote it into national regulations as sort of a backstop minimum standard everybody has to follow. And frankly, places like Australia have picked it up and said, this is a good way to deal with competitiveness and drive emissions down.
Now, you made the point to me in previous interviews that this is actually a well-run, well-designed, well-managed system.
Yeah, so the regulators are really knowledgeable in the facilities. I mean, these are highly complex facilities. Like no two facilities are alike, so they have very different emission profiles, very different production profiles. You know, you've got these gas plants that are like straddling a big pipe, big natural gas pipe, and they're stripping off little products. So that's a very unique facility. You've got slaughterhouses, right? You got to figure out how many emissions are in, basically waste ponds. So yeah, the regulators have their minds around the system. They've been doing it a long time, and they know the warts, strengths, and weaknesses. Yeah,
Given that our context here is oil and gas emissions,
yeah,
um, my understanding is that there is currently, and has been for a while, a very significant surplus of credits, which then drives down the cost of the credit and lowers the cost of compliance for the producers. Is that correct?
yeah. So right now we've got a $95 headline carbon price in Alberta and nationally, right? That comes from the federal government. We've got units trading at under $30 a ton. So, people can go on about, oh, $95, $100 a ton. The traded price right now is about 30 bucks, and that reflects a couple things. That reflects political uncertainty. Lots of talk in Alberta about the Alberta government killing Tier. That's very public. Lots of talk in the National Conservative Party of Canada killing it. And that's led to a lot of regulatory uncertainty. So that's one, stroke of pen risk. The other downward pressure on this thing is you've got a whole bunch of credits, offset credits in particular, that are going to retire between now and 2030. So there's about 60 million tons of these credits sitting there, which is 3 years worth of compliance. So what does that mean? We wouldn't have to reduce another emission or spend another dollar in Alberta, roughly. I mean, they're not equally distributed, but I mean, for just thinking about it, these facilities could meet compliance for the next 3 years without spending a dime because we got 60 megatons sitting there in these banks, and there's a use or lose provision. So if you don't use these things, they vintage out or they die because they're old and they can't use them. So everybody's got to use them. So last point, what does this mean? So yeah, go ahead, Markham. Yeah,
Well, I want to draw the parallel between the European trading system because that carbon market had a problem for a long time in
yeah,
that the regulator had issued too many free credits. And
yeah,
so that drove the price down, and it wasn't an effective carbon price at all. And finally, they brought in some reforms that shrunk the pool of available credits,
yeah.
driving the price up. And then it did become an effective carbon market. And I'm wondering, is that what we're facing now?
Yeah, so there's a number of things. These things weren't designed. The original Alberta blueprint for these things didn't really factor in markets. It was really about cost containment. And they didn't think about having mechanisms to reduce supply if you had an oversupplied market, a long market, which drives down the price where we are right now. And there's all kinds of reasons why we have too many permits. It's not just that the government's allocated too many. That's part of it. They changed the rules a few years ago. But the regulator just doesn't know what's going on at these facilities, right? Even with all the good data, suddenly there's a change in something, or a change in emissions, or a change in methane reporting, and suddenly a facility is more efficient and they're crediting like crazy, and the regulator can't see that all the time. So yeah, these systems don't have a way to soak up those extra credits and drive the price up. And they just aren't designed to be markets. And so we need this whole modernization thing. We need to think about these things to make them a little more effective.
Now, in the introduction, I mentioned that this March 19th letter that the 14 oil and gas CEOs had sent, and it talked about how the federal carbon levy on large emitters is not globally cost competitive. Well, the only really industrial emitters tax that these 14 companies face, for the most part, is in Alberta. That's why we're talking about tier.
Yeah.
And it seems a little disingenuous to me that these CEOs are asking for that system to be eliminated at the very time when there's a surplus of credits and the cost of compliance is quite low.
It's so low. So, there was some games being played, I think, with the election and the conservatives looking so strong in the poll, right? There's a lot of positioning. Business job is to not pay unproductive costs, right? Climate policy is not productive necessarily. It's socially beneficial, not privately beneficial. So every penny matters. So what are they paying right now? They are paying a timbit a barrel in compliance costs before tax and royalty interactions. That's 40 cents a barrel, and they can write it off 23% roughly federal provincial tax, and then royalty reductions. And typically, when we've done regulatory work for governments, we've assumed a 25% write off on that 40 cents a barrel. So they are not paying much at all. In aggregate, it looks like big numbers, multi-million dollars, but they're making how much a barrel? 50 cents on the dollar. That's on average. Some of them, yeah, they're making money. So this isn't a big number.
Now, I looked at Suncor's investor presentation last year, and this is, what they
Yeah,
tell investors is pretty well regulated. And what they
yeah,
said was, we paid last year, I guess that would have been 2023, 47 cents a barrel
yeah,
for compliance costs. Then they forecast out to a decade, so like 2034, and they said we anticipate at that time we'll be paying $1.70 a barrel. Well,
right.
47 cents is peanuts, as you just mentioned, and even $1.70 a barrel is not onerous. And so it seems like, part of one of the reasons why the federal government has come in with an emissions cap and is trying to get these companies and the province to cooperate is frankly because they've done a very poor job of lowering their emissions and kind of, I don't know, maybe gaming the system. Is that a fair take on it?
Yeah. So you look at that 47 cents a barrel, right? And that's before tax and royalty interactions. And there's all kinds of subsidy programs, tier recycling of revenue back. Now, the government of Alberta looks like they're taking 35% of those payments and funding their operations with it. And it's not going back to government or to
Oh.
industry, but that's another story. I don't know if you've seen that in their latest physical update at Alberta, but it looks like they're taking 35 cents out of the tier compliance fund, and that's not going to tech. But anyway, so there's all these subsidies as well on top of that, and so yeah, the industry, especially the oil and gas industry, is not paying a lot. Now, this cost isn't uniform across facilities, right? There are facilities that see economic hardship. The steel folks make 10 or 12 cents on the dollar instead of 50 or 60 cents on the dollar, and so they're challenged, and so it's you can't really sort of assume that the whole program is really weak. So you have a differentiated view in terms of the financial impact on folks. But yes, emissions are rising in oil sands, and the costs are low. Yeah,
I think it needs to be said because I can see viewers sitting at home going, well, why are the companies, why do they even care about 47 cents a barrel? But I think we need some larger context here, which is that oil companies have been in under pressure from investors for years now to return the maximum amount of money, revenue to the investors in the form of higher dividends or share buybacks. So when an investor looks at 47 cents a barrel, he says, "Why is that in the government's pocket instead of my pocket?" So the fact
yeah,
that we think it's small, that's not how investors look at it. They think of that's money that they should get, and they put pressure on the government, or sorry, on the company to make that amount as small as possible.
and most of the money, until recently, most of the money was going back to the large companies to help with innovation projects. The Emissions Reduction Alberta, $1 billion in reinvestment and that stuff over the years, a big number. So it's all gone back. Now every facility doesn't get back exactly what they pay, but there's all kinds of subsidy programs and innovation programs that have gone on. So it's very limited to take a look at that number and say, oh, this is pure bottom line, because it's not. It's not pure balance sheet impact on the facilities. And so looking forward, you've got border carbon adjustments coming. Now, it doesn't, the oil and gas folks, it's not a big deal, but for steel, manufactured steel products in the EU, it's a large number. We got about $3 billion right now in exports that are going to be subject to border tariffs in the European Union. And we want to diversify our trade, right? So backing away from these systems just means we're outsourcing carbon pricing. So if you don't want to pay the Canadian government, we're going to be paying the European governments. And by the way, the money goes back, like nobody keeps the money except Alberta a bit now, more now. But typically in the past, and the feds do it now, every dollar goes back to the companies. Ontario's program, there's actually individual company holding accounts. What you pay in, you get back, right? So it's basically forcing emission effective, energy efficient investments and not dividending out to shareholders.
Okay, bottom line here, Dave, is that it seems like while we have brought in policy at both the federal level and the Alberta level designed to lower industrial emissions, these programs are probably as a small percentage of the stringency actually required to get to effectively reduce any emissions at all.
Yeah, so the levels are quite low. Now, what's interesting about that low number is that if a company does make the investments and beat their performance standard, their target, they can credit, and those units are saleable. And then you're selling those at the full carbon price. Right now it's $30, but in theory, one of the reasons there's a lot of banked credits kicking around, carbon price was rising under the federal Liberals. And so the units that you're holding in your bank are appreciating in value faster than inflation, 15% a year nominal. So you're talking 10 to 12% growth in an asset on your balance sheet. So a lot of facilities were making some investments in banking. So there are investments. We calculated about $57 billion in Alberta, or no, sorry, nationally, in low carbon investments that can be linked to carbon pricing. Hey, we have to comply. Hey, we can make money. Let's make some bets. So that's been going on. And so the question then is the scale of that aligned with net zero and the longer term transition? And no, is it working to reduce emissions? You have to think of it this way. The oil and gas sector is expanding every day. Carbon policy has to work hard to keep emissions down or flat. So absent industrial carbon pricing, and we've done the modeling on this, emissions would be way higher, right? So just because emissions are flat or rising doesn't mean the carbon price isn't working. It means the carbon price is working hard against rising activity levels and rising emissions. So that's why the Fed's proposed an oil and gas cap. They have methane regulations for conventional. They're trying, subsidies for CCUS, carbon capture, utilization, storage. So yeah, there's a big ecosystem going on here, and it's not just, oh, we can't afford. Anyway, I'll stop. I'm rambling.
Dave, this is a very complex topic, and
Yeah,
it's not easy to understand, even for somebody like me who has been reading about it and interviewing about it for years. So I
yeah.
really appreciate your simple explanation here, and trust me, we will be revisiting this. I'm quite sure in the coming months. So thank you very much for this.
Markham, my pleasure. Have a great day.